All right. Good morning, everyone. I'm Joe Deere. I'm Chief Investment Officer of the California Public Employees Retirement System and privileged to be Chair of the Council of Institutional Investors. And it is my great pleasure to be able to introduce today's first speaker, Lloyd Blankfein, Chairman and CEO of Goldman Sachs. Lloyd is a 26-year veteran of the firm, having joined J. Aron, a currency and commodities business that became part of Goldman Sachs in the 1980s. Now, here Lloyd likes to make the point that he was actually rejected the first time he applied for employment at Goldman Sachs earlier in his career, and that J. Aron ended up being his ticket in. But putting aside the success of J. Aron, clearly the acquisition was a good move for Goldman Sachs also, since it netted the CEO who would one day lead the firm through some of the most tumultuous times in the history of financial markets. Lloyd's career continued its upward trend from his earliest days in the firm. He was named partner in 1988, co-head of the J. Aron division in 1994. He then became co-head of the fixed income, currency and commodities, the FICC division, when it was formed in 1997, spending the following 2 years in London. From 2002 to 2003, Lloyd served as vice chairman of Goldman Sachs with management responsibility for both FICC and equities divisions before becoming the firm's president and chief operating officer. In 2006, he assumed the top job when his predecessor, Hank Paulson, was nominated to be Secretary of the Treasury, continuing a tradition of public service that has become almost an obligation and cultural expectation of the senior leadership of Goldman Sachs. Stopping here, however, would fail to capture what are some of the most impressive elements of Lloyd's career and life story. In fact, a story that's a far cry from the caricatures we often have for CEOs of financial services firms. Lloyd grew up in public housing in what was at the time one of the toughest neighborhoods in New York City, East New York, where he attended public school. He told me that he likes to think that his first management of risk occurred when he looked out the window of the school bus and deciding whether or not it was a good idea to get off the bus that morning. But he eventually went on to earn scholarships to Harvard, both earning his A.B. there as well as a J.D. from the law school, and began practicing law before he started working on Wall Street. During his entire career at Goldman Sachs, he's been a strong steward of both the firm's famously resilient culture and its equally admired reputation, having played a major role in the bank's rise to the top of the financial firmament. More recently, Goldman was one of the few banks to perceive the downturn in housing relatively early and, as a result, avoided the worst of the credit crisis. That stewardship continues to serve Goldman Sachs well as the firm emerges from the current financial crisis with a client franchise that is arguably distancing itself further from the pack. Consistent with the Goldman Sachs tradition, Lloyd is actively involved in a variety of interests in nonprofit organizations, including serving as a member of the Harvard University Committee on University Resources, a member of the advisory board of the Tsinghua University School of Economics and Management, an overseer of the Weill Medical College of Cornell University, and as co-chairman of the Partnership for New York City. With that, please join me in a warm welcome for Lloyd Blankfein.
Joe, thank you very much. That's a very, very warm welcome for me in Washington. I had to check my calendar for a second there. Thank you. Good morning. I appreciate the opportunity to speak with you today. For more than 2 decades, the Council of Institutional Investors has committed itself to the values of accountability, transparency, and responsible ownership. I'm pleased to be able to speak to those principles in front of a group that has played such a powerful role in advancing them over the years. To begin with an obvious point, much of the past year has been deeply humbling for my industry. We held ourselves up as the experts, and the loss of public confidence from failing to live up to those expectations that we created will take years to rebuild. Worse, decisions on compensation and other actions taken and not taken, particularly at banks that rapidly lost a lot of shareholder value, look self-serving and greedy in hindsight. Financial institutions have an obligation to the broader financial system. We depend on a healthy, well-functioning system, but we collectively neglected to raise enough questions about whether some of the trends and practices that became commonplace Everybody have that now?
Hi, sir.
How are you?
Fine, thank you.
Good.
We'd like our money back.
What? Okay. How about this? I'll address that at the end. They've seen it, and then I'll address that at the end if you get off now.
Thank you.
Okay. What? Well, that's my proposal, but, you know.
If you could address it now, that would be great.
No, I understand, but. Meaningful change and effective reform are vital and should naturally emanate from the lessons learned. I'll discuss a few of the more important lessons from this crisis. I'd also like to highlight some of the regulatory guideposts that may help us to improve the broader systemic management of risk, increase the level of institutional accountability, and enhance investor confidence. Without trying to shed one bit of our industry's accountability, we would also further our collective interests by recognizing other contributed causes to the severity of the cycle we're living through. As a matter of policy, we allowed housing prices to be subsidized, including through implied government support of Fannie Mae and Freddie Mac. We watched as high consumption and low savings rates, as well as entitlement spending, were increasingly encouraged and financed through the twin deficits. Factors from both Main Street and Wall Street contributed to today's circumstances. Neither part of our economy acted completely independent of the other. So any examination of how we got to this point must begin with an understanding of some of the global economic and financial dynamics of the last 2 decades. Certainly, what started in a localized part of the U.S. mortgage market spread to virtually every corner of the global financial markets. But the genesis of the problem wasn't in subprime. Instead, the roots of the damage to our financial system are broad and deep. They coalesced over many years to create a sustained period of cheap credit and excess liquidity. The resulting underpricing of risk led to massive leverage across wide swaths of the economy, from households to the corporate sector to the public sector. I see at least 3 broad underlying factors. First, there has been enormous growth in the amount of foreign capital, much of it held in large pools, and a very significant shift in the balance of payments of many emerging markets. Second, and linked to this, nearly 10 years of low long-term interest rates. And third, the official policy of subsidizing homeownership in the United States. Let's take each in turn, beginning with the growth in foreign capital. Between 1992 and 2007, the U.S. current account deficit increased by more than 1,300%. During the same period, China's current account surplus increased by over 5,700%, as did the surplus for the oil-exporting nations. After previous financial crises, emerging economies began to self-insure against a repeat of those events by building up their foreign currency reserves. Their primary objective was to reduce their dependence on dollar-denominated domestic debt. Of course, the other, perhaps more significant factor in the growth in current account surpluses had been the record run-up in oil prices since 2000. Increases in global savings run almost parallel with the increase in petrodollar flows. The growth in foreign capital had a profound effect on the global economy. Foreign holdings of U.S. government and corporate debt skyrocketed. China's monthly average purchases of U.S. long-term securities went from less than $2 billion in 2001 to over $15 billion in 2007. The flood of foreign capital into safe and liquid assets, particularly U.S. Treasuries, helped push relatively low long-term interest rates down even further. And they stayed low, even after the Federal Reserve began raising short-term rates in 2004. This was accompanied by a significant reduction in inflation. Between 1985 and 1995, and the next 12 years, inflation-advanced economies fell by more than 1/2. Enormous excess liquidity, strong global economic growth, and low interest rates created a desire to find new investment opportunities. Many of the best were thought to be in the housing market. The reasons are threefold. First, governments, particularly the U.S., explicitly supported home ownership through a variety of government programs and initiatives. Second, mortgage assets were considered relatively impervious to sharp downturns. And lastly, the creation of more flexible and varied mortgage products attracted even more capital in search of higher returns. These factors, to varying degrees, contributed to a housing bubble, not just in the U.S., but in many other countries as well. While real home prices increased nearly 50% in the U.S. between 1998 and 2006, they increased more than 130% in Ireland, 120% in the UK and Spain, and over 100% in France. Not surprisingly, in the U.S., mortgage origination as a percentage of total mortgage debt outstanding rose from an average of 6.3% between 1985 and 2000 to 10% between 2001 and 2006. Subprime debt in particular grew from just over 2% in 2002 to 14% in 2008. In a stained environment of cheap capital, lending standards for residential mortgages simply deteriorated. As I've thought about our industry's understanding of the previous year's risks, it is important to reflect on some of the lessons. At the top of my list are the rationalizations that were made to justify the downward pricing of risk was different this time. While we recognize that credit standards were historically lax, we rationalized the reasons. The emerging markets were more powerful, the risk mitigants were better, there was more than enough liquidity in the system. We rationalized because our self-interest in preserving and growing our market share as competitors sometimes blinds us, especially when exuberance is at its peak. A systemic lack of skepticism was equally true with respect to credit ratings. Too many financial institutions and investors simply outsourced their risk management. Rather than undertake their own analysis, they relied on the rating agencies to do the essential work of risk analysis for them. This was true at the inception and over the period of the investment, during which time they did not heed other indicators of financial deterioration. This overdependence on credit ratings coincided with the dilution of the coveted AAA rating. In January 2008, there were 12 AAA-rated companies in the world. At the same time, there were 64,000 structured finance instruments like CDO tranches rated AAA. It is easy to blame the rating agencies for their credit judgments, but the blame is not theirs alone. Every financial institution that participated in the process has to accept part of the responsibility. More generally, risk management will come to define the events of 2007 and 2008. First, models, particularly those predicated on historical data, were too often allowed to substitute for judgment. In the last several months, we have heard the phrase multiple standard deviation events more than a few times. If events which were calculated to occur once in 20 years in fact occurred much more regularly, it doesn't take a mathematician to figure out that risk management assumptions did not reflect the distribution of actual outcomes. Our industry must do more to enhance and improve scenario analysis and stress testing. Second, size matters. For example, whether you owned $5 billion or $50 billion of supposedly no-risk super senior debt in a CDO, the likelihood of losses seemed to be the same. But the consequences of a miscalculation were obviously much bigger if you had a $50 billion exposure. Third, a lot of risk models incorrectly assumed that positions could be fully hedged. After long-term capital and the crisis in the emerging markets in 1998, new products like basket indices and credit default swaps were created to help offset a number of risks. However, we didn't, as an industry, consider carefully enough the possibility that liquidity would dry up, making it difficult to apply effective hedges. Fourth, risk models fail to capture the risk inherent in off-balance sheet activities, such as structured investment vehicles or SIVs. It seems clear now that managers of companies with large off-balance sheet exposures didn't appreciate the full magnitude of the economic risks they were exposed to. Equally worrying, their counterparties were unaware of the full extent of these vehicles and therefore could not accurately assess the risk of doing business. Post-Enron, that's quite amazing. Fifth, complexity got the better of us. The industry let the growth in new instruments outstrip the operational capacity to manage them. As a result, operational risk increased dramatically, and this had a direct effect on the overall stability of the financial system. Lastly, financial institutions didn't account for asset values accurately enough. I've heard some argue that fair value accounting, which assigns current values to financial assets and liabilities, is one of the major reasons for exacerbating the credit crisis. I see it differently. If more institutions had properly valued their positions and commitments at the outset, they would have been in a much better position to reduce their exposures. For Goldman Sachs, the daily marking of positions to current market prices was a key contributor to our decision to reduce risk relatively early in markets and in positions that were deteriorating. This process can be difficult and sometimes painful, but I believe it is a discipline that should define financial institutions. We mark to market not because we are required to, but because we wouldn't know how to assess or manage our risk if markets were reflected on our books. While this is not an exhaustive list of what went wrong, our focus is on learning from these lessons and others that will undoubtedly emerge as we work our way through this period. The administration, legislators, and regulators have begun to consider the important regulatory actions to be taken, and our firm pledges to be a constructive participant in that process. In that vein, I believe it is useful, in light of the lessons we take away from this crisis, to consider important principles for our industry, for policymakers, and for regulators. For the industry, we can't let our ability to innovate exceed our capacity to manage. Given the size and interconnected character of markets, the growth in volumes, the global nature of trades and their cross-asset characteristics, managing operational risk will only become more important. Risk and control functions need to be completely independent from the business units, and clarity as to whom risk and control managers report is crucial to maintaining that independence. Equally important, risk managers need to have at least equal stature with their counterparts in revenue-producing divisions. If there is a question mark or a disagreement about a risk limit, the risk manager's view should prevail. Understandably, compensation continues to generate a lot of controversy and anger. We recognize that having TARP money creates an important context for compensation. That is why, in part, our executive management team elected not to receive a bonus in 2008, even though the firm produced a substantial profit. Beyond TARP, public scrutiny, a renewal of common sense, and perhaps regulation will naturally affect compensation practices going forward. More generally, we should apply basic standards to how we compensate people in our industry. Compensation reflects an individual's ability to identify and create value, including his or her contribution to the client franchise, enhancing the firm's reputation, and contributing to the better functioning and efficiency of markets. Equally important, compensation should take into account strict adherence to a firm's management and controls, especially with respect to a person's judgment and exercising that judgment in terms of risk in all of its forms. That evaluation must be made on a multi-year basis to get a fuller picture of the effect of an individual's decisions. And individual performance must not be viewed in isolation. Individual compensation should not be set without taking into strong consideration the performance of the business unit and the overall firm. Employees should share in the upside when overall performance is strong, and they should all share in the downside when overall performance is weak. No one should get compensated with reference to only his or her own P&L. Compensation should encourage real teamwork and discourage selfish behavior that hurts the longer-term interests of the firm and its shareholders. We also believe it is important to set forth specific guidelines on how we compensate in our industry. Compensation should include an annual salary plus deferred compensation, which is appropriately discretionary because it is based on performance over the entire year. The percentage of compensation awarded in equity should increase significantly as an employee's total compensation increases. For senior people, most, if not all, of the compensation should be in deferred equity. Only the firm's junior people should receive the majority of their compensation in cash. As I mentioned earlier, an individual's performance should be evaluated over time so as to avoid excessive risk-taking and allow for a clawback effect. To ensure this, all equity awards should be subject to future delivery and/or deferred exercise over at least a 3-year period. And senior executive officers should be required to retain the bulk of the equity they receive until they retire. In addition, equity delivery schedules should continue to apply after the individual has left the firm. We believe attracting and retaining the best people is vital to our effectiveness and that incentives are an important element in that process. But we also recognize that misapplied, they can also encourage excess. As an industry, we need to do a better job of understanding when incentives begin to work against the social good rather than for it, and to take action to redress the balance. For policymakers and regulators, it should be clear that self-regulation has its limits. At the very least, fixing a system-wide problem, elevating standards, or driving the industry to a collective response requires effective central regulation and the convening power of regulators. While all of us in the industry have a common responsibility to ensure the system's operational integrity, it is not realistic to expect that one firm alone can fix a system-wide problem like unsigned trade confirmations or the establishment of a central clearing facility. Capital, credit, and underwriting standards should be subject to more dynamic regulation. Regulators should consider the regulatory inputs and outputs needed to ensure a regime that is nimble and strong enough to identify and appropriately constrain market excesses, particularly in a sustained period of economic growth. Just as the Federal Reserve adjusts interest rates up to curb economic frenzy, various benchmarks and ratios could be appropriately calibrated. To increase overall transparency and help ensure that book value really means book value, regulators should require that all assets across financial institutions be similarly valued. Fair value accounting gives investors more clarity with respect to balance sheet risk. How can one justify that the same instruments or risks are priced differently because they reside in different parts of the balance sheet, even within the same institution? The level of global supervisory coordination and communication should reflect the global interconnectedness of markets. Regulators should implement more robust information sharing and harmonized disclosure, coupled with a more systemic, effective reporting regime for institutions and major market participants. Without this, regulators will lack essential tools to help them understand levels of systemic vulnerability in the banking sector and in financial markets more broadly. In this vein, all pools of capital that depend on the smooth functioning of the financial system and are large enough to be a burden on it in a crisis should be subject to some degree of regulation. And yes, that includes large hedge funds and private equity funds. After the financial shocks and unsettling developments of recent months, I understand the desire for wholesale reform of our regulatory regime. And in many cases, it is warranted. But we also should resist a response that is solely designed to protect us against the 100-year storm. As long as human emotions influence decisions, this won't be the last financial crisis the world has to contend with. But most of the last century has been defined by markets that fund innovation, reward entrepreneurial risk-taking, and act as an important catalyst for economic growth. History has proven that a vibrant, dynamic financial system is at the heart of a vibrant, dynamic economy. The U.S. brand of that system has produced growth nearly one-third higher than the rest of the industrialized world over the last 2 decades. The events of the last year have put into stark relief the tension between innovation and stability. But if we abandon, as opposed to regulate, market mechanisms created decades ago, like securitization and credit default swaps, we may end up constraining access to capital and the efficient hedging and distribution of risk when we ultimately do come through this crisis. Certain developments of recent decades, like changes in the structure of financial institutions post-Glass-Steagall, have brought the risk of less frequent but more intense upheavals. The diverse income streams of mega financial conglomerates reduce the effects of the 10-year storm, but their size and ubiquity exacerbate the consequences of the 20 or 30-year storm. Over the last several months, there have also been a number of broader policy lessons. Many had previously accepted the bifurcation of Wall Street and Main Street, as well as the decoupling of the United States from the international economy. Both have proven false. In 2007, there were pitched debates over whether policy was being geared towards Wall Street at the expense of Main Street. Today, Wall Street remains destabilized, impeding the broader economy. In terms of international implications, we have also seen actions that, for all intents and purposes, are protectionist and self-defeating. For instance, recent legislation constrains the ability of financial institutions to hire employees who are in the United States through the H-1B visa program. This program helps bring the most highly trained and technical people into our labor market. The U.S. has always been a magnet for many of the most talented, hungry, and qualified people in the world. Especially at this time in our economy, do we really want to tell individuals who will help companies to grow and innovate, ultimately creating more jobs, that they should go to work elsewhere? Equally significant, and using Goldman Sachs as an example, we have approximately 200 employees who are in the U.S. because of the H-1B program. But we have 2,000 employees who are working overseas and paying U.S. taxes. Do we want to invite other countries to take punitive measures against us? This may be a relatively minor issue in the midst of the significant challenges we face, but I think it speaks to a potentially dangerous trend of withdrawing at a time we should do the opposite. While I don't dismiss political considerations, short-term salves like the Buy America provision or mandating a certain level of domestic lending will only end up harming the process underlying economic growth. All along, we have known that market events and economic trends are interwoven on a global basis. But the events of the last year have shown that connections are more direct and immediate than perhaps we previously appreciated. In times of economic distress, the relationships between creditor and debtor countries take on even more complex dynamics, especially as we are the largest debtor. We have learned that when a major financial institution fails in a debtor country, a creditor country is likely to pull back from its financing relationship in one way or another, and maybe in every way. For the United States at this time, the relationship is not just a matter of here and abroad. It is also a relationship between a debtor and its creditors. Certain of our economic decisions that have implications for our international partners could reverberate back to us very quickly and with great consequences in the current environment. I want to conclude today with the following thought. We are fighting for nothing less than the immediate health and security of every person. We can never forget the consequences of economic growth. More accessible health care, better education, less crime, tolerance of diversity, social mobility, and a commitment to democracy. In so many respects, change is the order of the day. We have much to do to repair our financial system and reinvigorate our regulatory structure. At the same time, our financial system, rooted in the belief of putting risk capital to work on behalf of ideas and innovation, has helped to produce a long-term record of economic growth and stability that is unparalleled in history. We have to safeguard the value of risk capital, which is at the heart of market capitalism, while enhancing investor confidence through meaningful transparency, effective oversight, and strong governance. But there should be no doubt markets simply cannot thrive without confidence. Though honest disagreements will occur, the best companies don't shy away or selfishly frustrate efforts to compel better industry practices. These companies recognize that they are the first to benefit from better standards, especially if their business requires extensive dealings with partners or counterparties. But we have to recognize a higher responsibility to speak up, to draw attention to potentially destabilizing trends, and to act like an owner responsible for the integrity of the system. I, for one, know we have not done the best job in the recent past, but working with you, as many of the world's most important investors, Goldman Sachs pledges to recommit itself to this fundamental obligation. Thank you very much.
Thanks very much. I have a couple of questions to ask, and then we'll turn it over to our members for questions. But in your discussion of potential regulatory reform, one of the things you mentioned was an overall regulator. Some people have talked about that as a systemic risk regulator or monitor or overseer. What are your thoughts on how that should be structured, and who should have responsibility for that?
No, I think it's sorry. No, I think we have, pros and cons in mind, but I think there's going to be a very, very lively debate, and, we'll no doubt participate in some way or in another, but it's not clear. I'll give you two considerations. One, obviously, some systemic regulator that can look over the whole field and get in and find institutions that may otherwise have fallen through the cracks is very, very important. On the other hand, if that regulator sits on top of other regulators and doesn't have its tentacles deep into aspects of the of individual companies and groups of companies, how are they going to get the information and access and their point of view? A lot of times people remedy situations by putting an umbrella organization, but if the umbrella organization is subsidiary to the information flow up from the other organizations, it's not going to be effective. So the question comes in, should there be an umbrella organization, or should one of the organizations now regulating the market, like the Fed, have omnibus powers and responsibilities? I see pluses and minuses to each of it, but I think that this is going to be a very, very important focus. But the main consideration is that there should be an entity, whether it's one of the existing ones or a new entity as an umbrella, being allowed to be kind of a free safety of the system and go wherever they think there's danger to the overall system.
Okay, thanks. One of the questions that's come up in the minds of a lot of people in the room, I think, is that, there's a suspicion that when AIG got its bailout, that the real intended beneficiary was Goldman Sachs and other investment banks. Could you explain how you think that went down, and what the real purpose of the AIG bailout was, and how Goldman Sachs benefited, if it did, from that?
Sure. Look, I think the AIG is a topic it just makes everybody upset and provokes a lot of anger from everybody to be in that kind of a situation where it just gobs of money and the way that company was managed. Now, I'll tell you, from our own point of view, we were a large trading counterparty of AIG. Frankly, we're a large trading counterparty of every institution. Now, we manage our risks very, very aggressively, including credit risks. And for AIG and for just about every other counterparty we deal with, especially professional counterparties, we have collateral and margin arrangements with all of them, as we had in place for AIG. And those collateral arrangements were effective from the beginning of our regulation, from the beginning of our relationship, and didn't depend on a ratings downgrade. So that's how Goldman Sachs deals with the market. We also dealt that way with Lehman Brothers and Bear Stearns, which is why our exposure to those entities was limited. At the end of the day, AIG owed us money, but we had value from them. That value was either in the form of cash or in the form of liquid securities. Had they defaulted to us and not paid us what they owed us, guess what? We would have liquidated the collateral and kept it and had the money. They wanted the collateral back, they had to give us money. By the way, a lot of this is very familiar to all this. More than a third, almost a half of the money they're talking about was part of the securities lending business, where we had securities, mostly government agency bonds, and they had cash. What they did with the cash, I don't know. The fact that they needed cash to return to us is not a surprise to anyone, but that had they not returned the cash to us, we would not have been out that money. We would have liquidated the securities we had and kept it. Most of you people are in that business as well. So that's the story. So technically, was cash given to AIG? Did AIG pass that along to its trading counterparties? Sure. But for those trading counterparties that had countervalue and margin, had they not gotten the cash in that way, they would have come out whole from a credit point of view. Now, there were gaps in that. AIG, not surprisingly, lagged its obligations, and there were holes. But whenever there was a hole in the difference between the collateral we had and what they owed us, we bought CDS and insurance against it. We spent over $100 million money protecting our shareholders against a default by AIG. So at the end of the day, we were sleeping very comfortably from a credit risk point of view with AIG. But that's not to say, by the way, that we all weren't benefited to the same extent. If AIG had caused systemic risk, most of us would have suffered, some of us would have done well. Some of us may have been short that day or long that day, we're not sure. But clearly it was going to be a disruption. And by the way, for the most part, not to Wall Street, for the most part to Main Street. AIG FP was a discrete part, but the vast mass of obligations of AIG was not to the financial community, it was to businesses and industries all around the world, and that was the threat.
Thank you. Let me turn to microphones and ask if there are questions from members. John?
John Lekumnik, IRC Institute. A question, you mentioned apex regulators can't regulate what they don't know, and also how interwoven all the counterparty risk is. One suggestion that has come up is that there are, Wall Street's constantly going to innovate, most recently CDS.
Could you step away from the president?
Sure, Wall Street is going to constantly innovate, most recently CDS, for instance. Would you support an idea that any security, for it to be tradable or assignable, must be registered to get a QSEP number or a CDOL number or something, so that the regulators could at least know the size of the market, which it didn't with AIG and Bear Stearns? And then the second question about transparency is, and what do we do about dark pools of liquidity, which many of us use, but which may, again, pose some sort of systemic risk? So how do we get transparency? Would you support the regulation of registration of all tradable securities?
Well, I wouldn't I wouldn't want a system that pre-cleared every QSIP number. Again, life is always trade-offs. It's a difference between nimbleness and stability of the system, and you have to stand where you are on the thing. And now, if the most recent memory, and recency is what really drives us disproportionately, both in risk management and in sentiment, we've just come off this thing where the biggest concern has been stability of the system, and maybe the pendulum will swing far in favor of stability as it should to regain confidence, but you don't want it so far as you crush innovation and nimbleness. I would say, and again, I'm flat-footed, but coming off your comment here, I would rather have a system that allowed people like innovators to go out and do their business and then reveal what they've done, be transparent to the regulator, have the regulator look it over and say, don't do any more, stop, hedge that, take that out of the market. In other words, I'd rather have the default be go ahead, but be transparent as can be and have the regulator respond than have everything gummed up with a kind of an FDA program where maybe it takes 7 years to get something to the market that'll actually be quite effective and good for the market.
Thank you. To be clear, I wasn't saying pre-registration. I was just saying that they had to reveal it was not true.
Anything, there is almost no degree of transparency that you can articulate that I wouldn't be in favor of with respect to our regulators.
Okay, thanks. Over on the left, please. It'll come up.
My name's Bess Jaffe. I'm from Hermes in London, and I thank you for coming today and sharing your insights. It's very valuable to the group of us. I had a question on your comments on executive compensation, and more broadly, compensation at the level below executives. Sorry. And one of the things that the IIF has recognized is that it was also the way that traders below the level of executives were being incentivized that led to maybe undue risk-taking. And I wondered, you talked about the mix between salaries and variable compensation. I wonder what your thoughts would be on maybe basing the performance period rather than just the payout period over a longer period of time. So rather than looking at somebody's results over 1 year, looking at results over 3 years, and then paying for that performance over a more sustained period of time. Because as long-term owners of companies, we recognize that incentivizing long-term performance is what we're looking for. So I just wondered if you'd considered that. Oh my God.
I think, and as I said in my remarks, I think you have to look at long-term performance, and we do. And we look at it over time, and we look at conditions in the market, and we look at people who make sacrifice. But I worry, and I'm not saying it won't come to this, but I worry about shoehorning people into specific rules, because one size may not fit anybody, let alone all. I know in our own organization we consider this, but could I design a rule that would work in all circumstances? So for example, we have a culture that's born out of partnership. We were a partnership till 9 years. We still have a partner pool concept. We call ourselves partners, and we behave that way in our organization. We make partners. People kill themselves if they don't become partner the year they're up for it, and all that kind of stuff, and it works out well. But in our organization, it's a natural culling of the herd. Anyway, in the nature of things, that has allowed our culture to be an ownership culture, which allows us to take people who are running the most lucrative businesses in our own firm.
Excuse me, Lloyd. I ask you on behalf of this audience
Well,
to have
since
some
you
respect.
wouldn't give us...
Are you, excuse me, do you belong to this organization? Are you? We would like to have some respect shown for our membership in our organization and our guest.
Are you for socializing?
Please. Please, very much.
Let me tell you, in response, aside from the demeanor and the lack of consideration, I think that reflects a prevailing view in the world, and if it's not articulated well, and if it's not articulated in a manner that's considerate of the people here, it's nevertheless real and visceral and felt by most people in the country, maybe everybody in the country, and I don't exclude myself from that. The fact of the matter is the taxpayers have put up resources for institutions that in the best of times had a swagger to what their contributions were, and turns out in the benefit of hindsight, overvalued them, and then had to be, in effect, rescued by a society that didn't do as well in the good times, or was made to suffer as, in the bad times. And it looks like some people come off of that looking well, and it's just the exact opposite of the way anybody wants it to be. I will say that in this, we are, again, look, I'm a lot of things. I'm an individual, I'm a voter and taxpayer, and I'm the CEO and chairman of Goldman Sachs, in which capacity I'm facing you today, but I'm all of those other things as well. But I can speak for Goldman Sachs in saying that we know that whatever relief was given, there were a multitude of purposes for why that was given, including the safety of the whole system, and so lots of organizations and entities were included, and it was also done as a way to leverage whatever stimulus would be given by strengthening the financial institution. There were institutions that desperately needed it, and institutions that could have used it. And it ran the gamut. But one thing I know for sure, any money that was given to Wall Street was never intended to be permanent capital. And the minute that an institution is allowed to return the money and is capable of returning the money while still carrying out its obligations and its role in the capital markets effectively, then it should do it in that minute. It's not a choice, it's an obligation to the taxpayers of that, and that's how we see the whole thing. And so, again, while this wasn't the most thing, I guess, you know, they were speaking for a lot of people in terms of the content, and I just wanted to respond to that.
Thank you very much. Gail?
Wisconsin Investment Board. My question is, leverage seems to have been one of the issues at the bottom of the financial crisis. And so could you speak about how leverage impacted the financial crisis and how you see the use of leverage changing going forward?
Yeah. Leverage, as I said, leverage is always, you know, leverage is at the bottom of every extension of risk. And I think, you know, it's a function also of sentiment, how much leverage people thought, you know, people had. The gross amounts of leverage are not always the most telling thing. If you looked at our own balance sheet at the end of the last quarter that reported, if we had something under $900 billion of assets, over $200 billion of those assets on our balance sheet were segregated, was other people's money, segregated funds, and I think something like $125 billion was cash. So if you looked at an absolute leverage, it's not telling. Then what you have to do is you look at the riskiness of those assets. And then riskiness of assets didn't tell the story because the riskiness of those assets changed over time. That's why I speak to the point of dynamic regulation. There are times in the market when institutions with the same amount of capital and the same amount of assets, and depending on that asset mix, would look highly leveraged or not highly leveraged. And I think the point of view, the purpose of regulators that are more embedded and understand the market and understand the positions with great transparency and the ability to revise the numbers and the acceptable leverage and the acceptable weightings and ask for more capital or lower balance sheets, I think is essential to the market, because whatever you do in the context of our recent experience might not adapt. I always know, this is my big, you should never go shopping, food shopping for dinner when you're starving, because that's when I buy the cookies and eat them on the way home. And I think going out and trying to figure out what is the optimal threading of the needle between safety on the one hand and wanting to have a nimble, effective financial system that sponsors growth on the other hand is a balance that not only should be made at times when we're much more, more reflective than reactive, but that balance might be different in the context of different kinds of markets. And that's why we want dynamic regulation, not just a one-time Maginot line, a fixed fortification that doesn't change and doesn't evolve.
Thanks. Bill?
Yes, I would like to ask a related question. Those women came in here, and I know how they feel, but I think populism sometimes has gone amok. I mean, there's no more important organization than the Council of Institutional Investors. And I congratulate you, Joe, and Ann, and the rest of the people. But you just came from the state of Washington to California. And the state of Washington cannot let their pension people leave the state of Washington. In other words, the whole issue of travel I know people were worried about this event too. Will it be perceived as too fancy? What can be done? They're talking about saving our dollars. We're talking about saving our conferences. It's not, in order to know, you have to go. And you, sir, I mean, I know Goldman has numerous fantastic events. How have you changed in that way? Are you able to go and learn the way you've traditionally done at Goldman before?
Well, we not only go, we go to events, we also sponsor events, but we've adjusted ourselves to the new dynamics and, frankly, the new reality. I mean, it may be, some may call it populism, but it's a real, we're a democracy. I mean, that's the bottom line. And what people think and what our constituency thinks is very important. You can't just hang out a shingle and be an investment bank. You have to be regulated and approved and licensed, and then you get the benefits of a lender of last resort and clearing systems and all sorts of societal benefits. As a receiver of those benefits, we willingly take on the burdens of responding to the needs of those constituencies. And so we have exceeded and have shaped ourselves. Now, the practicalities, we need to convene people. Look at this. This is as much fun as I'm having. It is very important for me to come and address this group. You are the most important investors and the biggest investors in the country, if not the world. And how would I be doing my job, serving my constituents, serving the interests of the country, if I did not try to take your temperature and let you take mine? So we're doing those things. Now, if 3 years ago we would have had the meat of the conference in the morning and a round of golf in the afternoon, guess what? We dropped one of those things. And there's a lot more of that, but that's what people want. These are tougher times, and as a matter of taste, and as a matter of how it seems, if nobody imposed that requirement to us, in my own sense of the evolving taste of things in the context of where we are, the old schedules that some of us may have gone to at the conferences just don't look the same and don't feel the same and wouldn't be as enjoyable. And so guess what? The kind of conference you're sponsoring with the speakers you have and the rat-a-tat one after the other, says nobody accuse anybody in this group of not working and furthering the interests of your investors in this conference. And that's the way, that's a matter of what people want, but it's also a matter of how we, I'm sure, and I speak for everyone, see the sensibilities of today's world.
Okay. Yes.
Deborah Gilshan from the Railways Pension Fund based in London in the UK. Working for a pension fund in corporate governance, I spend a lot of my time trying to make sure that our fund managers take corporate governance risk into account. For example, executive compensation practices that pursue excessive risk-taking, and to ensure that boards are well structured so that robust decision-making processes can ensue. As a fund manager, asset management for Goldman Sachs, I wondered if you could comment on how you think fund management industry generally can try and integrate corporate governance risks better into the stock selection decision-making process, and how Goldman Sachs does it.
Well, I think corporate governance is very, very important, the same way risk management is very important. And corporate governance is not just a function of whether that company is working well now, but to have the infrastructure so it would avoid future problems, much the way risk management, you could look at someone's P&L, but you also want to know their culture of risk management and the kind of guideposts they follow, so you can have a better inkling of next year's P&L. And so those provisions are important. Let me make another analogy to risk here for a second. I think it's very important that everyone consider it, but you have to do this on a company-by-company basis too. In other words, some investors have checklists. If you have this provision, you're fine. If you don't have that provision, it's bad, and they go through it. And some others even defer to agencies who decide whether they should do it, and partly because the agencies have experience, and partly to sheer, to shield yourself from any kind of, retrospective criticism. Look, this is what this agency has said, and so we will routinely follow that. And by the way, those agencies do very important work, are very good, are very sensible, but they also may have checklists. As a CEO of Goldman Sachs, I kind of know what works in our firm. I'd love to explain to you our culture of risk management, but I wouldn't know how to put down boxes that would reflect that culture, just that we've been doing it for 140 years and doing it. But if somebody needs a certain kind of element and we don't have that element, then we'll get a bad rating. I think that kind of absolute deference to just box checking is analogous to the kind of deference that people pay to credit rating agencies, which was a kind of a form of box checking as opposed to doing independent credit analysis. So I think these are all very important, and I purposely talked about it, just an element of it, because I think that's the one thing where I might want to inject a note of qualification or caution. But otherwise, we respond to these. We'd like to be the leader in governance, but there are certain things that we haven't necessarily followed that the investing community would like to see, because it may be wonderful and for the whole system. And I, as an investor, if you ask about us, GSAM as an investor, might like to see it for everybody. But that doesn't mean, but here I'm sitting here as the CEO and chairman of Goldman Sachs, and I'm thinking, this might be counterproductive for us, given our culture and our history, and boy, would I like to explain it to you and not rely on a checklist to communicate to you.
Thanks. I know we have time for at least one more question because it's coming from one of my trustees. Henry?
Thank you. Henry Jones, CalPERS Board. In your remarks, you mentioned about the off-balance sheet transactions being a contributor to the financial crisis, and I think everyone agrees with that. And as the path to recovery, a lot of actions have been taken. But then there's a number of people that suggest that this path may be impeded by a number of items, one of which was this off-balance sheet liability. And so my question is twofold. Your company, have you addressed that issue? And then generally, what are your views about the industry at large, whether or not that's a significant issue? Because some would suggest that that could be an impediment to this recovery.
Off-balance sheet exposures.
Yes, right.
I think there are things that have to be off-balance sheet. For example, contingent loan commitments, they can't be on balance sheet because they're contingencies and they don't exist as loans yet. However, a commitment is a commitment, and if you commit to lending money to a company whose credit has gone down and you have to perform, then that you can mark that commitment to market and you have a loss. Now, a lot of institutions won't run that through their P&L, but we always do. In other words, for us, we don't believe that anything is off balance sheet for point of view of your P&L. We mark to market commitments, first day commitments that we make. The day, changes company, credit goes down, we have a commitment outstanding, we'll mark it down, we'll reference the CDS and see where it's trading in the market, and we mark that down. I think that's absolutely essential, not only for several reasons, because it's right, because if you don't do that, how do you know what your exposures are and how do you manage your risks? And thirdly, how does anyone know what your relative health and solvency is? In other words, the third parties who want to transact with you, if they don't know what embedded liabilities you have and at what cost. So that's how we think of that. I know that's not everybody's accounting model, but that's the accounting model that we grow up under, and I know there's some controversy associated with that now, but we are, believers in that, and I alluded in my remarks to Enron. I think that was one of the things that was learned out of Enron, that things that are off balance sheet but that are commitments are every bit as much, have every bit as much of an impact on P&L and earnings as if it were security sitting on your balance sheet.
Well, I'm glad to hear that you address it that way. But in terms of the industry as a whole, do you think it has been addressed sufficiently?
I think it's getting a lot of attention now, and I think that I'm not sure we represent the majority view in some of these things. I think there is prevailing. I think in the context of the current environment, look, it's a tough position for regulators and people in the industry because people don't want to provoke. This is the moment that people want to tighten accounting regimes, which would have the effect of making people realize, making capital erode, or making people appreciate that capital has eroded to some extent. It's not the exact moment in time you would do that. At the same time, against the other thing, this is a time that calls out for confidence. And tightening that up would accomplish the latter objective, but maybe a burden on the former objective. And so that's a balance that people are doing. And I'm not sitting here and saying I have religion to the point. Well, we do have a religion from the point of view of running our business, but I can see the other side. And I'm not saying that everybody who disagrees with the way I just espoused it is wrong.
Thank you.
All right, this will have to be the final question, and you've been standing up the longest, so make it short.
Thank you very much.
We'll get done.
It's Kirsty Jenkinson. I'm representing F&C Asset Management from London. I'd be interested in your views on how we, as the investor community, what are the most important issues you think we should be discussing with companies at the moment? We're all very aware of the need for a sort of collective response to a lot of the challenges that the markets are facing. And we're trying to grapple with, we should be focusing on remuneration, whether it should be on, proxy access. What is, for your perspective at Goldman Sachs, what are the issues that you'd most like to be having with a dialogue with investors on at this present time?
I think all these issues are very important, but paramount. I mean, and these may be the most important in importance, not necessarily the most proximate in urgency. In other words, we have to do these governance issues, and we have to do them soon because they're related to confidence, and we need that soon. But more urgent, I think, are issues of liquidity, funding, when people's debt matures and what their access to capital would be. Those, for example, to me, in the long sweep of time, those generally don't get a lot of focus because companies are managed well and markets are generally open and available. And in this context, and by the way, things are getting a little, things are getting better in this respect now, even as we speak, but those are still issues for many kinds of companies, and those are clear and present and nearby issues relating to how the company is going to manage its way through the crisis. In other words, the kinds of stress tests that the regulators are doing on the banks, implicitly, we could all be doing on all companies and industries. What are your earnings? How are they impeded? What are they likely to be? What are your liquidity needs over the time? How do they match out over time? Will you have to go to the market for equity or debt, and will you have access to it? Those questions you can ask, and those are very clear and present. But all these other issues that we're talking about today, and I'm sure you're talking about in every session, those are also very, very, very important and very, very urgent and critical for the long-term health of the industry and people's confidence in industry.
That's great. We're out of time.
Well, thank you very much.
I want to thank you for your presentation, and hope you didn't mind the extra drama.